Hey guys, what's up and welcome. And today we have a quick three-piece. We've got what frightens me the most right now is bond yields, says Jason Trennert. Then we have Elon Musk X to test $1 per year subscription. They've got 540 million users. That's gonna be a quick 540 million extra dollars right there. Then we have, if your risk-free rate is 5%, then you should start looking at risk differently. She's gonna make some great points, I can already tell. As always, guys, if you enjoyed the video, hit the like button. Thank you for being subscribed, and let's quickly jump through these.
Markets have been remarkably resilient given the geopolitical headwinds, and is surprised bond yields have not rallied meaningfully. Jason Trennert's here, Chairman and CEO of Strategas. Is that right? So you think you're calling, so it's the opposite for the bond itself. So you're surprised that the yields aren't even higher than they are right now?
Well, I'm really surprised that yields aren't lower.
So you're saying that you're surprised that bonds haven't rallied?
Right.
So the person, yeah, okay.
Okay. So, I think there would have been a flight to quality given all the things.
So it's not what you're saying.
Yeah, so it's not what I'm saying. But
okay.
I think there should have been a flight to quality, but by the same token, wars are inflationary, and I think we're just reverting back to the mean as far as bond yields are concerned.
You're not turning bullish all of a sudden on stocks, are you?
No, I'm more cautious. I do think, I've had a reevaluation on the recession this year, because I do think if I miss something, it's clear that the labor markets are much more resilient than we might have thought, and that might be because we're short of labor, particularly working people, entry-level workers.
I will say, one of the things that's holding up this economy so well through all of this bad stuff is that stimmy checks, dude. All of that stimulus money has still been around. It started to run out, and whether you couple that with other savings or people just switched around how they looked at their money and started saving a little more, well, that whole trend only lasted for a year and a half, 2 years, and now we're back to zero savings, and the credit card bills are piling up. So something's going to have to give, okay? We're not just running out of our own money anymore. People are putting on credit card bills, and those interest rates are insane. And they're going to need their minimum payment. People are going to start living off so much debt that they just pay the minimum payment. That's how bad financially the world is right now for some people.
I just think we don't have enough of them. So despite the fact that profits have been a little bit lower and profit margins are lower, companies have been very loath to lay people off. So that's the unemployment rate is at 3.8%. You're at full employment.
And that's not to mention we're all at full employment, guys. If we start losing our jobs while people don't have even money and they have a credit card debt, what do you think's going to happen? This is going to snowball very, very quickly out of control. And I think it's just now starting to catch up.
So it's hard to get a recession out of that, but it also is hard to control inflation.
You think that the relative stability you're seeing in equities is masking some underlying weakness that is yet to be realized? I mean, are we on a precipice, or is this really showing that the underlying fundamentals are still good? Because the world is I mean, the world. I've seen Jamie Dimon and others say they've never seen things more concerning.
This is basically what I was just getting at. Let's see what he has to say.
Just the geopolitical, the economic backdrop. It's really frightening, even more so than normal.
I think he's right. I think there's a lot of things that are frightening. The thing that frightens me the most right now, I have to say from a market perspective, is bond yields, and the fact that in the absence of quantitative easing, in the absence of the Fed buying treasuries, treasury yields are going to move higher. And that's because our spending is out of control. We're running a budget deficit that's 5.5% of GDP at full employment. We've looked over the past 70 years. We've never run a budget deficit of 5% of GDP when
Not to mention, to build onto my story from earlier, guys, the government is not even managing their spending right. So we have people, the world of America, not managing their money right. Then we have the government not spending the tax money right. Who is spending money right? Who's left to spend money right? I mean, it is a lot of worry in this economy.
Unemployment rate wasn't above 7.
Jason, people have pointed to a lot of these concerns for quite a while, and then the government steps in and does something to change it.
That's right.
What would stop the Fed if things get really out of control from bringing back QE?
No, it's a great, and listen, we brought back QE for a short period of time after Silicon Valley Bank failed.
Right.
We
switched course this year. But when I say this, people are like, "Oh, that's not going to happen for a very long time." We switched course this year.
No, it's debatable whether. I personally think it's a decent bar bet. No one would ever know. But if we let Silicon Valley Bank fail, I'm convinced we would be in recession already. But we didn't. The Fed flooded the system with $400 billion of assets. We essentially backed.
So we still have a Fed put there.
Every deposit.
I think forever. Now, how do you ever convince people there's not one?
I think the only difference now is that two things that are different. One is that inflation is a binding constraint, where in many ways, as I've said before here, the Fed is fighting the federal government to bring inflation down. So if you're serious about bringing inflation down, it's hard to do it if you're running massive budget deficits. That's the first thing I would say. The second thing I would say is that interest expense on the debt is now spiraling out of control. So again, the Fed could step in and buy treasuries as they've done before, but something else will pop out someplace else, and that'll be inflation. So there's nothing stopping the Fed from doing that, or the Fed put. It's just that it's very hard to get it all set so that you have high growth and low inflation.
At least we have our political activity.
It's exactly what I was getting at, guys. It is hard. Even if we push it away, it's going to pop out somewhere else. That's actually a very troubling sentence. Something else will give, so they know, and that's why they can't take drastic measures. Anyway, we're going to jump into this quick 30-second video. It says Elon Musk's X to now, which was formerly Twitter, is going to test a $1 per year subscription to weed out some bots. Let's see.
Elon Musk is testing a $1 a year subscription model in New Zealand and the Philippines that he says could reduce bot usage on X. That's the platform, of course, formerly known as Twitter. Users will have to pay that annual fee to post content or like, share, and reply to post. Those who opt out will only be able to read posts.
Dang, to like, share, or post, you're going to have to pay that $1. Let's see how many people would just want to read, and let's see how many bots there are. I think that's a good idea. They say the average number on Google right now is 540 million active users. Even just $1 a piece, that's quick math, $540 million on the bottom line. So that's not going to be too bad there either way. Elon Musk definitely knows what he's doing there. Now we're going to hop into if your risk rate is 5%, then you should start looking at risk differently. I definitely agree with that. If everything was 1% and that's all you had to beat, well, stocks are a no-brainer. If you can get 4, 5, 6, 7% for free, well, stocks have risk and treasuries and bonds don't. So let's see what this woman has to say. As always, if you guys are enjoying the video, hit that like button. Let me know.
Mixed signals when it comes to the consumer, at least here in the United States. What's your take on the strength of the consumer, and how does that inform your opinion about the equities market?
Yeah, so we believe the consumer is strong. And of course, you see it starting to weaken across the edges, which is only to be expected from this level of strength. But to your point, Frank, that makes this inflation problem so complicated. And I think we think it all boils down to the fact that the interest rate sensitivity of the economy, especially the US economy, has really come down. So just interest rates are just not working to dampen the economy.
Yeah, definitely not working to dampen the economy, at least not as much as I think the Fed had hoped, trying to get down to that 2% inflation target. I also want to talk to you about just the higher for longer environment we're in right now. You recently put out some research calling the move higher in yields remarkable. So is it remarkable in a good way for investors and your clients? You're advising them to get more into bonds right now, and if so, is it short-term or long-term?
Yeah, well, it's about one question. Is the bond market doing the work on behalf of the Fed? Or has the Fed lost control over the bond markets? And that's why remarkable is either positive or negative, deciding on how you answer the question. We all know what's happening. We know that there's a huge supply of bonds, and there's a lack of demand of bonds because the world's largest buyer is no longer a buyer anymore. And that means that yields go up, prices go down. So we know what's happening. Is that dynamic over yet? Probably not. That's why we're still advising the shorter duration, the shorter end of the curve. But I think more importantly,
still calling for higher treasuries. Goodness gracious.
We are advising our clients to really have a serious calculation of risk. If your risk-free is 5%, you need to really start looking at risk differently.
So when you say look at risk differently, obviously you're saying you need a higher risk premium when it comes to equities. But does that mean you stay away from certain sectors? Do you focus more on different sectors? Do you focus more on dividends, for example?
Yeah, well, definitely. And I think
Well, the dividend stocks are getting wrecked just as hard, if not harder than everything else. So I'm not sure why you'd flock to dividends. I mean, longer term, obviously. But this last year, that hasn't paid out at all.
Frank, we've spoken about this investment manifesto that we've had in the past, but it's really about getting really nitty gritty and looking at businesses. Because if you look at the broad US equity markets, the risk reward of buying equities in the US just doesn't make sense. You're much better off buying bonds. Added to that is the fact that, analysts are going for more than 10% earnings growth next year, which isn't easy considering at the edges you see things starting to weaken. So again, it's all about specific companies, underlying business models. Where do they have pricing power?
So one question for you. I think we're going
That's very interesting and very well put. You guys, this is a stock picker's market, and it has been for a while, but every day that goes on and these problems don't go away, it becomes drastically more and more important to know how to read companies, know how to go into their balance sheets, know how to go into their financials, and see how this company is doing, not how the stock is doing, how the underlying company that you are buying is doing. And if you are getting it at a good price, you might have to pay up for it. It still might be a good price, but over these next 10 years, it could be a little bit different, guys. It could be a little bit different. I think the Magnificent Seven are still going to hold up pretty good. I think that is a very safe hedge against all of this. It's proving to be that as we speak. There's still most of them towards all-time highs, some of them past all-time highs. So it's very, very key now more than ever not to just ride the hype, guys. Make sure you're doing all your own individual research. Don't just buy companies because somebody else is buying them, because when they drop for no reason, you're going to feel very, very upset.
to be asking all guests about this. Of course, the yield on the 2 year is very attractive right now, basically 5.2%. But if we're in higher for longer, why not wait just a bit longer? We'll let those yields just creep up a little bit higher, or lock it in on the longer end, and then you have that risk-free 5% or so. I'm just looking at the 30-year right now, 4.96% for a longer period of time.
Yeah, and that all boils down to this inverted yield curve, which needs to get to normalization eventually. How is it going to become more normalized? Is the short end going to go up further, or is it going to be coming from the short end of the curve, or is it going to be coming from the long end of the curve? So if you lock in these exciting rates longer term, longer end of the curve, and you see yields continuing to go up because there's still more and more supply coming to the market, then less and less demand, that can be a painful trade. We feel more comfortable having a stronger accent at the shorter end of the curve, especially looking at the yields that you can get with much less duration risk. It just feels more comfortable.
All right, guys. So even people that are recommending not to be in equities, or at least recommending to be cautious when in equities, they're going into the shortest duration yields because they have the shortest duration bonds and treasuries because they are so uncertain. Even though they're certain that it's uncertain, that's why they're going over there. Once we get some certainty back in the market and we get some bottoms put in on all of these stocks, we get some good trading levels, and then we start to break out and up. We start to lose some of this bad news. We start to get some good news. If you think about it, all this bad news is going to turn into good news eventually, because once you have a whole big pile of bad news that you get to start saying, okay, now we don't have this as a problem. Now this isn't a problem. Now this isn't a problem. Well, that just makes the stock market go up and up, and we know people buy on a daily basis anyway. You add buying pressure, and guys, stocks can go to the moon. So while you can't be out, you can't be in. Pays to be a long-term investor that consistently invests, guys. Make sure to do your own research. If you enjoyed today's video, please hit the like button. I will see you tomorrow, and take it easy, guys. Peace.